Are you worried about not qualifying for a conventional mortgage? And welcome back to the channel. Today we're diving into a topic that's near and dear to many Americans' hearts: home ownership. Specifically, we're talking about FHA loans, a powerful tool that can help make the dream of owning a home a reality for many, especially those who might not qualify for a conventional mortgage. That's why we're going to break down FHA loans, the good, the bad, and the ugly, so you can make an informed decision about whether they're the right fit for your unique situation. So buckle up, grab your notebooks, and let's get started! Before we get into the nitty-gritty, let's start with the basics. What exactly is an FHA loan? Well, it's not some magical free money scheme, that's for sure. FHA stands for the Federal Housing Administration, a government agency that essentially insures mortgages made by approved lenders. Think of it like this. The FHA acts as a safety net for the lender. If a borrower with an FHA loan defaults, the FHA steps in and covers the lender's losses. This safety net allows lenders to offer more flexible terms, making home ownership more accessible to folks who might not have perfect credit or a mountain of cash for a down payment. There are pros and cons to consider, and that's what we're going to dig into next. Alright, let's talk about one of the biggest advantages of FHA loans: lower credit score requirements. With conventional loans, you usually need a credit score of at least 620 to qualify, but with an FHA loan, you can get in the game with a score as low as 580, that's right. Even if your credit isn't sparkling, you still have a shot at owning your own home. Now, I'm not saying you should go out and buy a house if your credit score is barely above water. But if you've been working hard to improve your credit and are responsible with your money, an FHA loan could be your ticket to home ownership sooner rather than later. Of course, the lower your credit score, the higher the interest rate you'll likely pay. But hey, at least you have options, right? And that's what makes FHA loans so powerful. Let's face it, coming up with a big old down payment is one of the biggest hurdles to buying a home. But here's where FHA loans come to the rescue again. With an FHA loan, you can get away with a down payment as low as 3.5% of the purchase price. That's significantly lower than the 5%, 10%, or even 20% that conventional loans often require. Now, I know what you're thinking. Dave, a smaller down payment means a bigger loan, and that means more debt. And you're right, it does. But it also means you can get into a home sooner, start building equity, and stop throwing your hard-earned money away on rent. Think of it this way. Would you rather be paying down your own mortgage and building wealth, or lining your landlord's pockets? I know what I'd choose. Just remember, the lower your down payment, the higher your monthly mortgage payments will be. So, it's all about finding that sweet spot between affordability and getting into a home that meets your needs. Now, let's talk about everyone's favorite subject: interest rates. We all want to get the lowest rate possible, right? Well, with FHA loans, you might be in luck. Because FHA loans are backed by the government, lenders are more willing to offer competitive interest rates. They know that even if a borrower defaults, they're protected by the FHA's insurance. This lower risk allows them to offer more favorable terms to borrowers. Now, I'm not saying FHA loans always have the lowest interest rates on the market, but they're often very competitive, especially compared to conventional loans for borrowers with lower credit scores. And let me tell you, even a small difference in interest rates can save you a bundle over the life of your loan. So it's definitely worth shopping around and comparing rates from different lenders to make sure you're getting the best deal. Here's a little-known perk of FHA loans that could come in handy down the road: assumability. Now, what does that mean, you ask? It means that if you decide to sell your home, the buyer can take over your existing FHA loan along with its current interest rate and terms. This can be a huge selling point, especially in a rising interest rate environment. Let's say interest rates have gone up significantly since you bought your home. A buyer might jump at the chance to take over your loan with its lower rate, saving the money over the life of the mortgage. Now, not all buyers will be interested in assuming your loan, but it's still a nice option to have, and it could potentially make your home more attractive to buyers down the line. Just remember, assumability is subject to lender approval, and the buyer will need to meet the FHA's eligibility requirements. All right, let's talk about debt-to-income ratios, or DTIs for short. This is a fancy way of saying how much of your monthly income goes towards debt payments. Lenders use DTI ratios to assess your ability to repay a loan. Now here's the good news for FHA loan seekers. FHA loans generally allow for higher DTI ratios than conventional loans. While conventional loans typically cap DTI ratios at 36%, FHA loans may allow ratios as high as 43% or even higher in some cases. This flexibility means you might qualify for a larger loan amount with an FHA loan even if you have other debts like student loans, car payments or credit card balances. But hold on a second, don't go thinking you should max out your DTI just because you can. Remember, a higher DTI means you're carrying more debt, which can put a strain on your finances. All right, folks, it's time to talk about the elephant in the room: mortgage insurance premiums, or MIP as they're commonly known. Because FHA loans come with lower down payment requirements and more lenient credit score guidelines, lenders require borrowers to pay for mortgage insurance. This insurance protects them from losses if you, the borrower, default on the loan. Now here's the catch. FHA MIP comes in two flavors: upfront MIP and annual MIP. You'll pay the upfront MIP, which is 1.75% of the loan amount, at closing. You can either pay it out of pocket or roll it into your loan balance. Then, you'll pay the annual MIP, which ranges from 0.45% to 1.05% of your loan balance, depending on your loan term and loan-to-value ratio. This annual premium is typically divided by 12 and added to your monthly mortgage payment. And here's the kicker: unlike private mortgage insurance, PMI, on conventional loans, which you can usually cancel once you reach 20% equity in your home, FHA MIP typically lasts for the life of the loan if you put down less than 10%. Now let's talk about another important aspect of FHA loans: property requirements. The FHA has a long list of property requirements that cover everything from safety and security to structural integrity and overall livability. These requirements are designed to protect both the borrower and the lender from ending up with a money pit. So, what kind of things are we talking about here? Well, the home must have a functioning roof, a sound foundation, working plumbing and electrical systems, and be free of any major health or safety hazards. If the property doesn't meet these standards, the seller may be required to make repairs before the loan can be approved. This can sometimes slow down the closing process or even derail the deal altogether if the seller isn't willing or able to make the necessary repairs. Now let's talk about loan limits. The FHA sets limits on how much you can borrow with an FHA loan, and these limits vary depending on where you live. The limits are tied to the median home price in a particular area, so they're generally higher in more expensive housing markets. In most cases, the FHA loan limits are sufficient for the average home buyer. But if you're looking to buy in a particularly hot real estate market where prices are sky high, you might find yourself bumping up against those limits. So before you set your heart on that dream home, be sure to check the FHA loan limits in your area to make sure you're within the guidelines. Alright, let's face it, nobody likes waiting around for a loan to be approved. But here's the thing, FHA loans often have longer processing times compared to conventional loans. This is because FHA loans involve more paperwork, stricter guidelines, and additional layers of approval due to the government's involvement. While waiting for your FHA loan to be approved might test your patience, it's important to remember that good things come to those who wait. Well folks, there you have it. We've covered the ins and outs of FHA loans, from their lower credit score requirements and smaller down payments to their mortgage insurance premiums and property requirements. As you can see, FHA loans can be a fantastic option for many home buyers, especially those who might not qualify for a conventional mortgage. They offer a pathway to home ownership that might otherwise be out of reach. But like any financial decision, it's crucial to weigh the pros and cons carefully and determine if an FHA loan aligns with your individual circumstances and long-term financial goals.